In my last video, I promised to show you how to make money no matter what the market was doing. It could be going up, down, or sideways. You can make money in all three of those kind of markets. But in this video, I'm going to focus more on the sideways market. Now, my name's Maggie Roth, and I have been trading for over 15 years very successfully, and options are my main vehicle of trade. If this video inspires you, please consider signing up on the link below. It's easy to understand how to make money when the market's going up. You buy low, you sell high, you make money in between. Great. Going sideways? Almost impossible to conceive unless you understand the beauty of options. Let's look at a sideways market. The example I'm going to show you is Netflix. It was earlier this year. Definitely in a sideways pattern, no doubt about it. To understand how you can make money in that sideways pattern, you first have to understand time decay. New concept for you. And you need to understand the difference between buying an option and selling an option. So let's start with time decay. Remember that an option is sold for a definite expiration period. And over the life of that option, no matter when you bought it, it will lose value as time gets closer to that expiration period. Now, the loss of that value doesn't happen just automatically on the last day of the option. It happens all the time you're holding it, little by little. Now, it accelerates as you get closer to the option's expiration. The time decay is known by the Greek letter theta, so you'll hear both terms, time decay and theta. The important concept is when you buy an option, time decay is not your friend. So if you buy something and it's eroding over time, that means when you go to sell it, it will be worth less just because of theta. Now, there are other factors in there, but that's how theta affects it. When you sell an option, the opposite happens. You sell it, time erodes the value of the premium, and when you go to buy it back, you can buy it for less. So we always say that when you sell premium, that time decay is your friend. When the ticker you want to trade is going sideways, consider selling an option rather than buying an option because of time decay. It will help you. Next consideration are the rights and obligations of options. When you buy an option, all you're buying is the right to exercise that option at a certain price within a certain time period. Your risk in the trade is only the premium that you paid for that option. Now, when you sell an option, you are obligated to fulfill the terms of the contract if the other side of the trade so chooses, which means you have to buy back the stock at the current market price and provide it to the person on the other side of your trade. So you sell it, you are obligated. So imagine if you just had one contract, it would mean buying 100 shares to provide to that person when he decides to exercise the option. I know this is throwing a lot at you, so let's use Netflix for an example. Here's the, if you had gotten exercised against and the current stock is trading at 182, you would have to buy 100 shares. That would be $18,200. And you would turn that stock over to whomever bought the option. So your risk in that trade is $18,200. That's not a good thing. So the dilemma is, we know the best trade is to sell premium when the market's going sideways because of time decay, but at the same time, the risk is astronomical when you sell an option. We actually refer to that as naked trading. So what do? Well, I like to do a credit vertical spread. on something that's going sideways. You can either do it as a put or a call. And remember, all you have to remember is that you're both buying and selling in the same expiration period. That is the spread. What you do is you sell closer to at the money, to where it's now trading, and you buy further out away from where it's now trading. The results will be a credit to your account. Here's an example. This is Netflix again. You would sell the 187.50. It is trading at 182.50 right now. So you sell that and you bring in $4.17. You turn around and you buy an option at the same time, just a little further out of the money, and you only pay $2.57. That means you have a net credit of $1.60 going into your account, and that's $1.60 per share. So the risk is also reduced when you do a vertical. The risk is the difference between the two strikes. In this case, 187 to 192.50, that's $5. So why does that work that well? Well, you're going to get called out at that 187.50. You got to provide that stock to whomever's calling you out. But at the same time, you can force somebody else to buy the stock at 192.50, making the difference $5. And that's your total risk in the trade. A lot better than the $182 per share. Only $5 per share. So this video introduced you to a whole new world of possibilities. We focused on one way to make money in a sideways market. You were introduced to a lot of new concepts: time decay or theta, rights of buying an obligation or buying an option, obligations of selling an option, combination trade called a vertical. In our case, we did a credit vertical. We also touched on controlling your risk in options. In the next video, I will be talking about how to make money in a down market. Guys, I make a lot more money and a lot quicker in a down market. That's my favorite market to trade. We put these tips out every week on Tuesday. If you like these videos, please subscribe to this channel and like us below. I'm Maggie Roth, and I'm your investing buddy. I love to teach, and I love to show all the possibilities of option trading. So see you in our next video. Thanks very much.